Coming up, the RBA board meeting minutes released. The Australian share market falls, but gold hits a record. All the details next. It is Tuesday, the 2nd of April 2024, on a day where the Australian share market fell 0.1%. We'll have more details with Zoran Kresovic from eightcap later. But first to the Reserve Bank, where what's being called the most dovish piece of communications from the RBA board since it started hiking interest rates back in May 2022. That's according to the Commonwealth Bank, and it follows the RBA's monthly board meeting minutes, which were released today. For more, I spoke with senior economist at CBA, Belinda Allen. Belinda, what is it in the RBA minutes released today that confirms a neutral policy basis? What's different about it, and where does it say that it didn't consider a rate rise this time round?
It's a good question. So if you go back to May 2022, when the Reserve Bank first lifted the cash rate, in every single minute since then, it's talked about the board considering either a rate hike or the case to leave the cash rate on hold. In the minutes for the March policy meeting, we just got the discussion about why they were leaving rates on hold. So there was no discussion about lifting the cash rate in March.
So you're now predicting a cut in September, the Commonwealth Bank is. That's earlier than many others. Some even think the first rate cut will be back in 2025. Why? What are you seeing?
We've held our view that the first rate cut would be in September 2024 for quite some time now. All of that was dependent on our outlook for inflation. We have inflation moderating relatively quickly from here to reach 3% by the end of this year. We also expect the labour market to loosen as well. And we've also seen the economy slow. So because of all of that, we do expect the Reserve Bank to cut in September. And I think the evolution of the board's language as well further reinforces our view for that first rate cut in September. But it really all comes down to the inflation outlook. Inflation is going to slow from here. We know rates are restrictive where they are at 4.35%. They don't need to stay there for a prolonged period of time if you have slower growth, a loosening in the labour market, and inflation moderating.
You're also predicting a few more rate cuts to come after that. What are the risks to that forecast?
It's interesting. We're about a month out from the federal budget. So we have the federal budget handed down on the 14th of May. We know there's also tax cuts coming in on 1 July this year. So a lot of the risks in our view come down to fiscal policy. If we do see further cost of living relief, that boosts consumption, which expands the economy, then that's a risk to the start date for interest rate cuts. Another risk out there is if we don't see that moderation in inflation and loosening in the labour market that we're expecting as well. So the risks at the moment are tilted to a later start date, but the recent economic data flow, maybe apart from the February labour force data, does point towards that September date for the start of the rate cut cycle.
And finally, what does this all mean for home values, though, if we do indeed start seeing interest rates fall, as the Commonwealth Bank is predicting from September? Because we saw house values, according to CoreLogic, continue to rise right now. Those numbers out today. The Commonwealth Bank is surprised at the strength so far this year. Wouldn't rate cuts then, if we start talking about rate cuts, lift prices even more?
The home price story is a really interesting one at the moment. That the start of 2024 has come in stronger than what we had expected. And I think at the moment, what's going on in home prices is very much divorced from the economic data and the economic reality in Australia at the moment. So we know there is just absolute imbalance between supply and demand for housing at the moment. We've been underbuilding for years. Population growth's very strong. We're seeing demand for housing across all ownership sectors, first home buyers, investors, upgraders, which is pushing home prices higher. We do expect that to continue, and there are some upside risks to our forecast for 5% growth this year. But for the Reserve Bank, I think last year they were talking about rising home prices, rising lending for housing, as saying rates are not restrictive enough. They're not talking about that anymore. So there is the risk that when the Reserve Bank starts cutting, that will fuel home prices. The headwind to that, of course, is the housing affordability challenges that are becoming ever more present in the Australian economy.
Belinda Allen there from the Commonwealth Bank.
Now, Market Day on the SBS On the Money podcast.
To the Australian share market now, which did fall, the S&P ASX 200 down 0.1%. For more, I spoke with Zoran Kresovic from eightcap.
A lot of sectors were actually down. The only two sectors that were actually performing positively were the energy sector and the materials sector. Throughout the day, we've seen fairly sluggish moves on the back of US data that came overnight, with the manufacturing sector actually contracting. But all in all, fairly sluggish day, following through from the US markets.
So earlier in the day, we were hitting another record and now it's down. I mean, I've seen a lot of commentary about the market potentially being quite frothy. Is there the potential to still rise, or do you think there's a bit of a correction to come, for example?
I'm in the camp that we are in a bullish market, and that's pretty evident. I mean, if you have a look at the markets globally, focusing on the US and European equity markets, we can see that we're actually reaching an all-time high on daily or weekly basis. We have got a clear breakout on ASX 200, and generally speaking, what you would normally see with frothy markets or markets that are coming to an end is actually when the trends tend to narrow in a range. What we're actually seeing on ASX 200 at the moment is actually the price is expanding and it's not narrowing at all, which indicates to me that we are likely to see higher peaks and higher troughs, or our market continue to go up. Another thing that we need to take into account as well, Ricardo, is the fact that obviously valuations are pretty high, sentiment is pretty bullish, investors are on the bandwagon. And if you have a look at in the US, in terms of the large investments or portfolio management by asset managers, hedge funds, and the big banks, we can see that in terms of the actual large money, around 80% of the smart money is actually long right now. So it's actually very, very hard to be bearish in the current uptrending market.
We heard from the RBA today in the form of its minutes, along with some stronger than expected manufacturing data out of the US. What's the market feeling about the timing of interest rate cuts?
Well, that's a great point, because what we've seen, if you go back in December 2023 and market predictions in terms of the interest rate cuts versus what the bond market was actually pricing in, we were actually anticipating around 6 to 7 interest rate cuts starting in the US and probably 3 to 4 interest rate cuts here in Australia locally. Now, that's obviously changed. The sentiment has changed. We've seen the manufacturing PMI come out last night at 50.3 versus the market expectation of 47.8. So for the first month, it's been actually positive. For the last 17 months, so previous 16 occasions, it was actually fairly negative. Now, I'm not going to say this is going to be a deal breaker in terms of the rate cuts or moving into the middle end of the year, because what we also need to take into account is that by the end of the month, we've also got average hourly earnings out of the US, we've got the unemployment data, and most importantly, we've got the non-farm payroll data. Locally in Australia here, obviously the tune has actually somewhat changed. We can see that based on the RBA minutes today, there is absolutely no prediction, or markets are not, the RBA is not actually pricing in any more interest rate rises. Now, if you actually have a look at the commentary in terms of this or the month of March to prior months, we can see there was actually potentially 25 basis point interest rate hike on the table. Now, that's actually been completely eliminated, and now we can actually purely focus on the first interest rate cut. Now, the market is actually pricing for the first 25 basis point cut to come in the month of September. It might be pushed back a little bit because we are so data dependent. We've got a strong labor market in Australia here locally, and the wages are actually being quite strong as well. So we will watch this closely over the coming weeks.
Okay, gold's trading at a record, I think, again today. What's driving it, and what's your take?
Well, gold has been probably amongst cryptos one of the best performing assets over the past few weeks. So in terms of the actual gold itself, we can see that it's a good hedge against risk in the market. We've got so much global geopolitical tensions going on at the moment. And if you have a look at the China market as well, I mean, obviously China is actually slowing down with a whole heap of concerns around the property market, and we can see that China has been one of the biggest net buyers of gold through Hong Kong since 2018. So it seems like the governments are actually buying, as well as retail investments are actually trying to hedge their exposures as well. Middle income earners in China as well are actually buying gold as a hedge against the risk, and we can see that globally, the central banks are loading or currently accumulating around 20% of gold in their portfolios. So seems like hedging is the right way to go about it at this point in time.
And finally, where do you see the opportunities for investors?
There's quite a lot of opportunities at the moment. I mean, obviously, as I mentioned just now, gold is probably the one that's actually driving the headlines at the moment with 0.9% increase overnight to around $2,254 per ounce. I also see probably a bit of upside in terms of the crude oil as well. So we can see the crude oil is actually around $84.50 right now, or 16% up since year start. If we can see, the actual economic environment continue to strive over the coming months, and demand for crude oil actually continues to increase, and we see further cuts from OPEC over the coming weeks, then they might actually offset the crude supplies from the emerging countries itself, which would mean that we could probably see a little bit more upside in crude oil as well.
That's Zoran Kresovic there from 8cap. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed